Uh, Hello students, I hope you have understood the fundamentals of financial management, particularly the sources of finance, the introduction of it, the importance of sources of finances, the various classifications including the long term, short term, internal and the external sources of finance. Today we are in the second lecture of the sources of finance, which is purely based on the ownership securities, which we can refer as equity share capital. So, now I am going to start the lecture number 2, that is based on the equity shares. Here I am going to discuss introduction to equity shares, features of equity shares, what are the advantages of equity share if a company raises capital through this share, then what are the drawbacks or the disadvantages, and finally we would also be looking into the factors which makes equity shares as a most suitable form of financing. And in the end of this lecture, we shall also dwell upon the preemptive right which is given to the equity shareholders. Let us see the introduction. Equity capital refers to the funds raised by a business in exchange for ownership shares. It represents the ownership interest held by shareholders in a company. That means, this share can be issued by the help of common shares, and where the investors who invest in the equity share capital receives in return the dividend and also the capital appreciation resulting in capital gain. Now, there are 4 concepts related with the equity shareholder. Number 1 is authorized equity share capital, which represents the maximum amount which a company can raise from the ordinary shareholder, and this can be changed in the prescribed manner. Number 2 category belongs to issued capital, which is the portion of authorized share capital offered by the company to the investors, whereas the subscribed share capital is a part of issued capital which has been accepted or subscribed by the investors. And finally, the paid up capital is the actual amount paid by the shareholders. Then there are related concepts to equity share, that includes the face value of the shares, the issue price of the share, and also the market value of the share. So, ordinary share typically have a face value in terms of the price for each share, the most popular denomination being ₹10, and the price at which the equity shares are issued is the issue price, whereas the market value may refer to the price which equity shares are traded in the stock market, and against this the book value of the share refers to the value where the paid up capital and the reserve and surplus, when these two important elements are divided by the number of outstanding shares, we get the book value. So, here we have seen what is the face value, what is the issue price of the share, what is the market value, and also the book value per share. Now, here this is the time we should discuss in detail the characteristics of the equity share. Here we have divided the total discussion under 4 heads. Number 1 being maturity, number 2 claim on income, number 3 claim on assets, and number 4 is the controlling power. Now, let us see what is the feature of equity share in terms of the claim. Now, as we know that the equity shareholders are also called the owners of the company. So, equity shareholder have a residual claim on the company's income and also on the assets. That means, they are entitled to receive whatever remains after paying to the debt holders and also to the preference shareholder. So, they are the legal owners of the company. Then comes the amount of dividend that equity shareholders are entitled to. Here I would like to tell you that the dividend on the equity shareholder is not fixed and depends on the company's profitability, and even if the profitability of the company is intact, it is the discretion of the management whether to pay dividend or not to pay dividend to the equity shareholder. Then comes the redemption feature of the equity shareholder. Since they are the owner of the company, the equity share capitals are irredeemable in nature. That means they do not have a maturity period. But for compensating the loss that they have in terms of having the last priority in terms of their claim on income, now the equity shareholder have been given the voting rights. That means in every important decisions, equity shareholders can cast their vote, and also to ensure the liquidity of the equity shareholders, they can sell their share in the secondary market. So, that means the equity shareholders on one hand, they have a great amount of risk associated with their returns and also in terms of their claim on the income and the assets, where they enjoy great amount of controlling power, which compensates about the risk that they bear in the company. Now, if you have understood the features of equity share in terms of the maturity period, in terms of the claim on income, in terms of claim on assets and also the controlling power, let us move to the important benefits and the disadvantages that the equity share offers to the company and also to the investor. Let us first start with the advantage of equity share to the company. Number one, this is a permanent capital. That means once the shares have been issued, company is under no obligation to repay the capital to the shareholder. Exception to it is a one provision that is known as a buyback of share. That means in exceptional case, the company has got the right to buy back its own share from the investors. So, that means in some rare cases, equity capital do not provide the permanent capital to the company. Second most important benefit is the no fixed obligation. That means the company is under no pressure to pay the dividend to the shareholder. If there is a profit, company can pay dividend, and if there is no profit, company is not supposed to pay dividend. Next, even if profit is there, if the company has good projects in hand which is going to sustain the good return in future, company may decide not to pay dividend to the shareholder. Third benefit associated with the equity share refers to the claim on assets. That means the investors do not have any claim on the assets of the company. This arises from the fact that whenever the equity shares are issued, company is not required to put any of its fixed asset as collateral. So, that means even if company is passing through distress, then company's assets will remain intact. The investors cannot sell the share into the market to realize their capital. Then there are certain indirect benefit of issuing equity share by the company. Whenever the company approaches to any financial institutions, it has to show that it has some cornerstone, some foundation stone in the company in the form of equity shareholder. So, debenture can be issued, the term loan can be taken by the company only when there is some amount of cushion available in the company in the form of equity shareholder. Then lastly, as we have seen, there is no charge on fixed asset, company is under no fear of liquidation or fear of bankruptcy. That means shareholders cannot take any company to the court if the dividend has not been paid. So, this gives a great amount of freedom to the company when the capital is raised through equity shareholder. Then let us move to the other segment where we can discuss the advantage available to the investors. Number one, the capital appreciation. We know that the return on the equity shareholder for the investors comprises of two important components. Number one is the dividend received on an annual basis from the company whenever profit is there. Secondly, the company shares are traded in the stock exchange. When there is more demand for the shares, the prices may go up, and as a result, if the investors want to sell their share at a higher price than at what they have purchased the share, they would receive a capital appreciation. Second, the shareholders have also been given voting right. That means in each and every important decision of the company, whether it is a merger of the company or overseas operation or company is going to buy back its share, every decision has to be passed on by the majority shareholders. So, this is an important weapon given in the hand of the shareholder, and where the shareholders can also cast their vote by using the provision of proxy, where somebody else on behalf of the shareholder can cast a vote. Number 3 is the preemptive right. It is very important, we shall discuss in detail later on, but let me tell you the concept of preemptive right. Here, whenever the company is going to issue shares publicly, it has to offer the shares to the existing shareholder, so that the existing shareholder can maintain their proportionate right in terms of the net worth, in terms of the income of the company. Lastly, there is another advantage associated with the equity shareholder in terms of more income. That means, whenever you compare the interest rate on debentures or the rate of dividend of the equity shareholder, we find that dividend rates are higher than the rate of interest, and it is quite logical because they bear more risk. So, they should be rewarded with a high rate of dividend. Now, can we move to the another segment where the disadvantages of equity share would be discussed. Let us see what are the limitations of equity shares for a company. Number 1 is the high cost of fund, that as we have just mentioned, the rate of dividend would be higher than the rate of interest. So, here the cost of equity seems to be higher than the cost of debt, and this would also affect the overall cost of capital of the company. The another cost associated with the equity shareholder is the flotation cost and the cost of underwriting, and this is quite high because company has to incur so many other formalities which will involve certain cost which apart from the rate of dividend offered to the shareholder. Next is dilution of control of existing shareholder on sale of new shares to outsider. Here the preemptive right gives the shareholders a right to maintain the proportionate share in the net worth and also in the company, but the same becomes a disadvantage for the shareholders, like if the existing shareholder do not exercise their right and the company goes for follow-on public offer, then the dilution of control may take place on account of follow-on public offer. Similarly, the management do have to share the controlling power with the shareholder. No certainty of finance. This is very peculiar feature because as we know that the economy passes through recession and boom, and in some time when the condition of the capital market and the condition of economy is not good, the certainty is not there whether the issued capital will be subscribed by the public or not. Another disadvantage is less flexibility in capital structure. As we know that the preference share and the debenture has certain maturity period, but the equity capital once issued will remain permanent in the company. So, company have very less flexibility in manipulating their capital structure of the company. Then also the complex issuance process can pose a difficulty for the shareholders, for the company as well as for the shareholder. Let us see if there are any drawbacks for the investors as well or not. Here the equity capital in reality is a risk capital. So, if the profit is there, the shareholders will receive dividend, otherwise they may have to wait for the next year when the company generates profits, then it will be paying dividend to the shareholder. Then scattered and unorganized sector are unable to exercise effectively their controlling power over the company. Then shareholder cannot claim for dividend when there is no profit. Then there can be wide fluctuations in terms of price. So, here many times if the company is facing the problem of certain distress, it is possible that the shareholders may lose dividend and sometime they may lose the capital invested by them. Then capital loss during the depression, yes, we have just mentioned that in the scenario of low profitability, the shareholders may lose their return from the company. Then uncertain marketability, as we have seen that the shares can be traded in the stock exchange once the company has come with the IPO and the shares are listed in the stock exchange. But the marketability is limited to the fact that whenever there is a buyer, only then the seller can sell the share. Then there is a provision of taxing the income received in the form of dividend. So, there is a problem of income tax on the dividend. Here now we are moving to the one segment which gives extraordinary power to the equity shareholder, which is known as the preemptive right. Here the equity shareholder, we have seen they are the owner of the company. So, they have the residual claim on the earning of the company, but in the course of follow-on public offer, every company is under legal compulsion to offer these shares to the existing shareholder first to maintain their proportionate interest in the assets, earning and also in the control of the company. So, this preemptive right is nothing but an extraordinary power vested in the hand of the shareholders, whereby equity shareholders has got the right to purchase the additional shares whenever the company is coming with the public issue. Here there are three options available before the shareholder: whether they can exercise their right, they can sell this right in the market, or they can forfeit this preemptive right partially or completely. So, when they exercise the right of getting the right issue, then they will have the proportionate right or the existing proportion in the control and earning of the company. But as the next option is concerned, they can also sell their right in the market, and finally they can forego their right partially or the completely in case they are not interested. Then share available as a result of non-exercise of rights would be allotted on a pro rata basis to shareholders who are ready to exercise their right. And if there is any balance, even offering the share to the existing shareholders, this can be offered to the public also for the subscription. So, with this preemptive right, the management can give a guarantee to the existing shareholders that yes, since you are the owner of the company, you are the first one to provide the foundation stone, to provide the cushion or buffer to the company. We will keep in mind that your interest is protected. So, in brief, an investor will suffer dilution of financial interest when he does not exercise his preemptive right. So, the interest can be protected only when they exercise their power, and with this they are able to fulfill their three important objectives. Number 1, to safeguard the interest. Number 2, to retain their proportionate shares in the net worth of the company, and the preemptive right also gives them right to retain their proportionate share in the earning of the company. So, these are the objectives of preemptive right. Then we can discuss in what circumstances the equity shares proves to be the most beneficial security of the company. But let me have a recap of what we have done. Now, we have started with the equity shares definition, which says that equity share is a share in the share capital of a company and includes the stock whenever the distinction between stock and share is not made. Then we have discussed the features of equity shareholder under number 1, maturity, which says up to what time the share capital would remain with the company, whether it has a maturity period or not. Secondly, we have discussed the claim on income, where there are 3 important things: priority, certainty and the amount. As far as priority is concerned, the equity shareholder has got the last priority, because only after making payment to debenture holders, preference shareholders, equity shareholder will receive any dividend from the company. As far as certainty is concerned, we have seen that there is no certainty, there is no guarantee. Only when there is a profit, company can pay dividend to the shareholder, and even if profit is there, company withheld with the provision of paying dividend to the equity shareholder. As far as amount is concerned, it is totally in the discretion of the management what percentage or what amount of dividend would be paid to the shareholder. Thirdly, we have seen claim on assets. Shareholders, equity shareholder particularly, do not have any claim on assets, because no fixed assets of the companies are kept as collateral while issuing the equity shareholder. And finally, the controlling power, where the equity shareholder will get the voting power, that they can cast their vote through proxy as well, and which will be enabling them to interfere and intervene in all the important decision of the company. So, here suitability of equity share can be discussed with the help of the following points. Number one is when the marginal cost of debt is high. This point says that equity shareholders can be obtained by the company when the marginal cost of debt is high. We know that cost of debt is lower than the cost of equity shareholder. That means it is always beneficial for the company to raise capital through debt rather going for equity shareholder. But because of the high debt equity ratio or because of the distressful condition of the company, the institutions are ready to give loan or debt capital only at a rate higher than the previous rate of interest. In that case, it is better not to go for capital, but to issue equity share. Then when existing debt equity ratio is high, many times the institutions insist that the debt equity ratio should not be more than 2:1 if a company wants to raise capital through debt. In that case, equity share is the only option. When company is facing the problem of low profitability, in that case the company would be finding it difficult to pay the interest and the principal whenever it is due. So, it is better to raise capital through equity share. It is also very true for the startup companies who are very nascent, who are very new and do not have any retained earning in their balance sheet. So, in that time it is better not to enter into any fixed obligation of paying interest to the debenture holder, rather go for equity shareholder. When company is facing liquidity crisis, what is liquidity crisis? There are two conditions of any company. Here, when company has profit but cash is not there. Second one is when company has profitability but sufficient amount of cash is there. So, this situation is known as the liquidity condition, when company can meet out its obligations with the available cash. So, if the company is facing liquidity crisis, means there is no cash available in the company, it is better not to issue debt capital, because we know that under provisions of debt agreement, company would be under compulsion to pay the interest and the principal. Otherwise, the debenture holder can take the company into court. So, that is how the liquidity problems force a company to go for equity share. Another related feature is where company when has very less fixed asset to offer as collateral, then it is again advisable to the company to not to go for debt, rather go for equity capital. Finally, when the elasticity of demand is high, then the situation favors the equity shareholder. What is elasticity of demand? Here, when the prices go up for certain commodity, then the demand may be down or it may decrease. As a result, the company may face the problem of lower sales and lower profitability. So, in that case, when the elasticity of demand is high, that means the demand of the product is related to the price of the product, it is better not to enter into the problem of issuing more and more debt capital, rather going for equity share could be the only option. So, here we have seen that how the equity shares can be a very win game for the company as well as for the investors, and this is how we have come to the end of this lecture, which was based on the ownership security, where equity share being the permanent capital in the company, putting no burden on the company to pay dividend on time. It is the company and its management, they may decide to choose this equity share capital as the method of financing their growth, their expansion, and also their opportunities which are there in their hands. So, with this we come to an end with the discussion on equity shares. So, with this we come to an end on the deliberation on the equity shares. I hope you have understood the concept related to equity shares. If any feedback, I am most eager to see your feedbacks and the reviews. Thank you everyone.